And so if you're, let's just say, a seller in the U.S., what do you do?
You sell. There's not going to be a better time to sell than today. The time of testing the market is over. You find a real estate agent that is both knowledgeable in the market and skills-based, one that comes in and prices your house properly, right? And doesn't, mess around. So he's watching the market. If the market continues to decline, he's bringing the price of your house down because the time for testing that market is over.
Right.
Welcome to the Nick Fong Podcast. As the broker and owner of Ronival Real Estate, Nick has spent nearly 20 years in Baja California Sur. And in this podcast, he'll be talking everything Baja, from food and culture to real estate and property management. And now, here's your host, Nick Fong.
All right, welcome back to the podcast. Aaron Cuha, welcome.
Thanks, Nick.
On this a couple times, and I wanted you, especially for this podcast, because there's been a lot of change going on in the real estate market, and with interest rates rising and the fear of the hot real estate market cooling off and maybe in a downward slide. So you being a real estate coach with Tom Ferry for a number of years, you have quite a number of coaching clients all around the world, really. So what countries do you coach?
So currently I coach in USA primarily, but I have clients in Kenya, in South Africa, in Portugal, Prague, and New Zealand.
And occasionally in Mexico when
occasionally
I can
in Mexico.
Get his time, right? And so, well, thank you for being on this. And you also coach real estate mortgage professionals. And so, and those are all in the United States.
Yeah, all in the United States. I've got about 10 mortgage clients. So, there's 3 or 4 of us at Tom Ferry that coach mortgage clients.
So just to timestamp this is mid-June, June 16th. So as of June 16th, what's going on in the real estate market in the U.S.?
That's a great question. I think, the real estate market's a little bit volatile if you listen to the news, right? We're seeing, historic inflation numbers. Last Friday we had inflation numbers. The consumer price index, or consumer pricing of inflation, came out at 8.6%, which caused the Federal Reserve meeting that happened yesterday and today to raise rates, the federal funds rate about 0.75 of a point instead of their half point, what they had expected. And that caused some turmoil. Technically it doesn't have a direct impact on 30-year mortgage rates, but it does because of the turmoil. But there are other factors that are affecting 30-year mortgage rates right now, and that could be worse. So,
where are the 30-year mortgage rates on average right now?
Currently, 30-year mortgage rates are about 6%. On Friday, they were about 5.5%. But with the economic indicator, with the inflation on Friday, and there was a mortgage-backed securities issue on Friday where mortgage-backed securities went no bid for the first time in 40 years in the U.S., and that caused rates to jump 0.5% overnight.
What does no bid mean?
Well, we package mortgage-backed securities in a pool of securities, and we sell them off to institutional investors.
Right.
And none of the investors were willing to buy any of those mortgage-backed securities, so there were no bids.
No
at all.
way.
Yeah.
First time?
For 1981, I think was the last time. I mean, close. It didn't happen.
In the recession, it didn't happen?
No, even with the recession, even with non-performing mortgage-backed securities, they were still, but the government was stepping in and buying mortgage-backed securities then. But there were no bids. People were still bidding.
Right.
In this case, you have mortgage-backed securities that are performing, but they're at, let's say, 4%. And most institutional investors are looking at that and thinking, well, why would I buy this when in 2 or 3 weeks they're all going to be at 7 or 6?
But inflation's at 8-point-something%, right?
Well, there's the big challenge, right? So historically in the United States, we like to keep inflation around 2%. Historically, the feds will raise the federal funds rate to a rate that's at or above the inflation rate in order to turn inflation back down. So between the mortgage-backed securities and the inflation, we have to raise rates, 8 or 9 more times and get the federal funds rate up around 8.
Yeah. And so people have context that we're talking not only to a real estate coach that coaches real estate agents around the world and a dozen or so real estate mortgage professionals, but you actually ran one of the biggest mortgage shops in the United States.
Correct.
And so the company...
So we own a company called directlender.com. We had about 280 offices, about a little shy of 3,000 originators. And of course, we sold that company during the crash to try to save it, unsuccessfully ultimately. But, I was president of California Association of Mortgage Brokers and, pretty active in this market.
So you're qualified. You know what you're talking about when it comes to mortgage interest rates. You were just telling me that you're going to Tom Ferry's podcast next week.
Yep, probably.
Recording.
The 29th, I think. Yeah.
And so obviously he's a very respected expert in real estate. And so the fact that you're going to be, I got him first, Tom. I got him first. And so what does that mean with the rise in inflation, rise in mortgage interest rates for the real estate market?
Well, I think historically the feds have open market policies that they can do, federal funds rate. They can do, they can release treasuries and buy treasuries. There's a lot of stuff that they can do to bring it down. If they're unable to bring inflation down, long term, it could have some detrimental effects on real estate, right? If interest rates continue to rise. Nobody thinks that's going to happen. We have an election in November, midterm elections, and it could be pretty hard on them. If you look at any of the KCM stuff, Keeping Current Matters, if you look at Lawrence Yun, the chief economist for NAR, nobody's predicting that home values decrease over the next 4 years. So I think I read an article today that said the most pessimistic economists, so a pool of 4 or 5 of the top economists, Fannie, Freddie, Ginnie, MBA, they say that by 2026, we'll on average, we'll see a 10.19% increase in home values on average across the U.S. The most optimistic is saying 40% increase between now and the end of 2026.
That's kind of crazy.
That's 10% a year or something like that still. The average is probably that 3 to 4% a year increase in home values. If you look at a historical home values all the way back to 1910, home values do this. Even in a dip, if you look at a big graph, you won't even see the dips because the dips are so small. I think in the last 8 recessions, there's only been 2 times when home values depreciated. So there technically it shouldn't have nothing bad should happen.
Yeah.
Now that's not to say we won't see a dip this year.
What do you mean, dip in home prices? Yeah, volume of sales?
So if every economist is saying we're going to see a 10% increase this year, right? And there's 30 or 40 markets that are 15 to 18% already.
Okay.
They're likely going to see a 4 to 5% decrease from today through the end of the year. They're still going to end up positive
for the
year over year. Right. But we could see slowing. I think that we'll see slowing in the higher priced areas. We'll see some softening, and eventually in the mids. I think the days of 15% appreciation are over, altogether. But we'll definitely see some slowing if the feds don't get a handle on the mortgage-backed securities issue. If the feds don't get a handle on inflation, then interest rates could. I'm going to be an alarmist here. To get money going back into mortgage-backed securities, theoretically, they need to get the rate somewhere near 8%. That would put conforming 30-year fixed rates at 10 or 11.
So that
would cause a problem.
That's like the 70s, right? The Carter era.
No, not the 70s. I got my license in 87. Interest rates were 13%.
In 87, it was that high?
Yeah, and coming off of 17, right? So, so that's in the 80s, right? But there's a big difference between the value of money today and the value of money then. Mm-hmm. The cost of houses then versus today, income then versus today. Being in 10% now is probably the equivalent of 17 back then. So there's some look to be had at that. But if I read Lawrence Yun's post from yesterday on Twitter, and I think he gave a very eloquent. He's probably the most intelligent economist I've ever met. I put him with, let's say, Greenspan or Ben Bernanke, and at the end he slipped something in. He said, unless the United States finds a way to release oil reserves, we're likely to see something dramatic happen in interest rates and housing.
Wow.
And that, to me, he had 3 paragraphs in this little sentence at the very end, which tells
footnote.
A footnote. But hey, I'm going to slip this in. This is the thing that's going to fix it. And I don't know how we're going to fix that.
Hey, thanks for being a part of the Nick Fong Podcast. Make sure to subscribe to the podcast to get the latest updates. And if you're watching this on our social channels, please like and share. And if you want to be featured or you want me to talk on a certain topic, food, activities, culture, real estate in the Baja, drop a comment. And so if you're, let's just say, a seller in the U.S., what do?
You sell. There's not going to be a better time to sell than today. The time of testing the market is over. You find a real estate agent that is both knowledgeable in the market and skills-based, one that comes in and prices your house properly, right? And doesn't, mess around. So he's watching the market. If the market continues to decline, he's bringing the price of your house down because the time for testing that market is over.
Right. And when you say testing the market, what do you mean by that? Because for the last couple of years, it's been crazy. So testing means what?
So for the last couple of years, we're getting 20 or 30 offers. We're getting $100,000 over asking. You're getting sellers coming in. Well, my house, my neighbor's house sold for $900,000. So my house is worth $1.5 million. Because my
that's testing.
Because my house is prettier than theirs, right? And that's testing the market.
Right.
So, if a house sold for $900,000 2 months ago and it was a little bit nicer than your house, you're not going to come in at 9 today. If you do, you're going to sit.
Mm-hmm.
Right. And then you're going to end up chasing this market down. And to me, chasing the market down is like juggling knives. Okay. You're going to get cut.
Yeah. How bad is it going to be?
You're going to get cut, right? So price competitively, price aggressively. I currently coach about 75 clients, and my clients that are coming in aggressive on pricing are getting multiple offers and selling at or just above market. Mm-hmm. My clients that come in above market are doing price reductions, and then nobody's coming back to look at the houses.
And I can say that applies in our market here in Los Cabos too, because we're so heavily affected by the real estate market in the States.
Yeah.
Well, most of our owners, most of our buyers are coming from the U.S. So they have that mentality. And so they bring it south of the border.
Exactly. U.S. and Canada. I coach a team that did, $2.6 billion in sales in Vancouver last year. And we had this conversation today on a coaching call where they're seeing exactly the same thing in Canada that we're seeing here in the U.S.
And we're seeing it here in Mexico. And so what if you're a buyer though?
So if you're a buyer, once again, it's now is a great time to buy. Don't get me wrong. If you said I'm a buyer, I don't have job security, or I'm going to have my family's growing, and I may only want to be in my house for 2 years, I'd probably be a little questionable about buying. But if you're going to be in your house 3, 5, 7, or for life, right now homes are staying fairly stable or a small depreciation, right? But interest rates are going up. So figure if you could have afforded a house, if you were pre-qualified for a $600,000 house on Friday, you could only buy a $550,000 house on Monday, just with that 0.5% jump.
Correct.
And if it goes up another 1%, you're going to lose another 10% in what you can afford. So your affordability is going down every day.
So 1% interest rate, more or less 10% in buying power.
That's correct. So if you're a buyer, now's the time. If it's sad that it works for both ways, but this is one of those rare storms where it does.
And what I've been coaching my agents is working with buyers that are waiting on the sideline. You could do so, especially if you're an investor and you're looking for the quick flip or that 20 to 30% return. It still exists, at least in our market for the time being. But if most of our clients are doing it for a lifestyle, they're going to buy and it's a generational property. They're going to be owning it, or their family's going to own it for 10 or 15 years. And so that's always going to go up in value in an area that's always in high demand and that has the lifestyle. And we have the lifestyle clearly because you live here.
Right? Well, don't get me wrong. If you're buying cash and you're buying for investment, maybe now is not the best time to buy. Maybe we will see some depreciation in home values. Like we said, most economists are saying we're not. But that doesn't mean we're not going to see it in the next 6 months, or that doesn't mean there's not going to be opportunity. I had a client today tell me, she was super excited on the phone because she's like, I wrote one offer. It was contingent upon them selling their house and it got accepted. And she's like, I haven't written one offer in 2 years. I usually write 30 or 40 offers for my clients to get a deal done.
Yeah. And so it's a little bit easier not having to go through so many offers to get them accepted, but you're probably going to have fewer buyers if you're a buyer agent in the market. What about the inventory issue? Because what I've been saying is we're still in an inventory crunch. So even if interest rates go up, people still need to buy and sell in any market. And so when you have a limited inventory, simple economics, prices will go up.
That's probably the number one reason why I'm telling my clients, like, look at this isn't something that you need to hide under your desk about. This isn't, we could call it COVID 2.0. COVID 1.0 was half the agents hid under their desk, half the agents got busy and had their best year ever. People that were out buying and selling real estate, owners and sellers, buyers and sellers, had great success, yes. Right? We're in that same market again. Some people are going to be scared and some people are going to conduct business as usual. The ones that conduct business as usual are going to have huge success. Like you said, there is still a lack of inventory and there's still a fairly decent demand. Mm-hmm. That's going to keep our prices steady.
Yeah.
That alone should keep it, short of a force majeure, short of something dramatic happening in housing or in interest rates or in oil.
Yep. Or a war
yeah.
Yeah. So you're getting ready to head out of Cabo for the summer, but you're going to be back. You were saying you're going to be spending your time where?
So we'll spend the summer in Park City. So we'll go back to Park City and spend some time there, and we'll come back and forth. Like I think we're going to hopefully host a big Thanksgiving here for Thanksgiving at the house here, and then just travel back and forth. Come back for winter and spring again.
You're just leaving for the season.
Just the season.
And so you've been coming. Remind everyone, for how many years?
I think I came to Cabo the first time in 1977. I was 8 years old. So, caught my first marlin with my father. And he thought that would turn me into a man. And all it did is turn me into a fisherman.
That's a man.
Right?
It's a fisherman.
He had read too much Ernest Hemingway. And he had this belief that, this was going to make me something other than it was.
But, you've grown up to be someone of somewhat.
Yeah, but it probably didn't work as quickly as he would have liked it.
Okay, there you go. And with that, Aaron, thank you for being a guest again on the podcast, and I hope to have you again. And until the next one. Bye.
My pleasure, brother. Thank you.
Bye-bye. Thanks, brother.
Thanks for listening to this episode of the Nick Fong Podcast. Make sure you subscribe to the podcast and the YouTube channel at youtube.com/Ronival Real Estate and follow Nick on Instagram at NickFong_Ronival. Ready to find your Baja dream home? Check out the latest property listings at Ronival.com or FindMexicoHouses.com. Hasta luego.